Ladies and gentlemen, good day and welcome to Q4 and FY22 earnings conference call of Hindustan Oil Exploration Company Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anuj Sonpal from Valorum Advisors. Thank you, and over to you, Mr. Sonpal.
Thank you. Good morning, everyone, and welcome to the earnings call of HOEC Limited for the fourth quarter and financial year ending to 2022. My name is Anuj Sonpal, CEO of Valorum Advisors. We represent the investor relations of HOEC Limited. Firstly, let me mention a short cautionary statement. Some of the statements made in today's Concall may be forward-looking in nature. Such forward-looking statements are subject to risks and uncertainties which could cause actual results to differ from those anticipated. Such statements are based on management's beliefs as well as assumptions made by and information currently available to management. Audiences are cautioned not to place any undue reliance on these forward-looking statements in making any investment decisions. The purpose of today's earnings call is purely to educate and bring awareness about the company's fundamental business and financial quarter under review. Now let me introduce you to the management participating with us in today's earnings call and hand it over to them for opening remarks. We firstly have with us Mr. Elango, Managing Director, Mr. R. Jeevanandam, Executive Director and Chief Financial Officer. Without much delay, I request Mr. Elango to start with his opening remarks. Thank you, and over to you, sir.
Thank you, Anuj. Good morning, everyone. Happy to connect with you all on this Q4 FY22 earnings call. Jiva, our CFO and whole-time director, is with me. Valorum Advisors, our investor relations advisors, are also on the call. I hope everyone has received our updated earnings presentation. We have also uploaded it on our website for your reference. I am pleased to share that the well D2, which is predominantly gas producing in our B80 block, has been brought online and gas production has commenced. After treating the produced gas to meet the specifications of ONGC, it is being pumped into ONGC pipeline to pack the line effective 31st May 2022. This is a 56 kilometer 14-inch line that has not been used by ONGC. Therefore, the volume of gas to be packed in the line through B80 gas will be discussed and agreed with ONGC. Post that, buyer will be formally notified to receive the gas to commence the commercial sales. Initially, the well will be flown at lower rates. Post stabilization of all parameters, the flow rate will be increased to meet the committed gas volume of 10 million standard cubic feet per day. Our gas processing capacity is about 15 million standard cubic feet per day. Being an offshore block, B80 development has posed multiple challenges. It has been a difficult journey due to the disruption caused by the pandemic and later the cyclone. Post installation of single point mooring system and mobilization of floating storage offload vessel, we have started the pre-commissioning of the processing facilities at KGB offshore installation. The facilities include separators, gas dehydration unit, and compressors, among others. These were installed more than a year back, as these equipments were not on board for more than a year without being used. Commissioning of each equipment took much longer time than expected. Tuning of each process equipment are required to be carried out by introducing hydrocarbon by adhering to high level of safety standards. The contractor has to mobilize personnel and spares from the original equipment manufacturer from various parts of the world. Overall, this has taken much more time than initially envisaged. Subsea pipelines and umbilical systems were installed in May 2021 before the cyclone. We observed some losses of hydraulic fluids in the umbilical joints while opening the wells. This was subsequently addressed with the help of ONGC dive support vessels through subsea diving operations. Rectification was successful in respect of D2 well. However, in D1 oil well, After holding the pressure for some time, we observed the loss of hydraulic fluid once again. We are drawing up plans and procedures for mobilizing the DSV of ONGC again to attempt rectification of the umbilical issue of D1 well at the earliest. Therefore, initial production is only from D2 well. This will be followed by D1 well on successful repair of the loss of hydraulic fluid, which is being attempted with ONGC support. We wish to clarify that both the wells have demonstrated the expected reservoir pressure while flowing, and we have not seen any issues with the productivity of the wells. The delay in commencement of commercial production from B80 by more than a year has caused severe strains on company's resources. Offshore assets require safe maintenance, whether it is operating or not. We had to stretch our limited resources to deal with the unanticipated challenges. Our plan is to remain focused on B80 as we have to bring it on full production mode. At Dirok, we pursued a strategy of value over volume to realize a better gas price. During Q4, we continued to supply gas at a premium price to Numaligarh Refinery, Assam Gas Company, BCPL and NEPCO. Due to this, in Q4, the premium sales constituted 40% of total gas sales, fetching a premium of over $1 per MMBTU to the government notified prices of 2.9 per MMBTU. Balance 60% of the produced volumes were supplied to oil at government notified prices. However, lower offtake by downstream consumers reduced our average production in Q4 to about 28 million standard cubic feet per day. Overall, Dirok field continues to perform very well, maintaining excellent reservoir performance. Till date, the field has delivered nearly 50 BCF of gas and 1 million barrels of condensate. The Halong modular gas processing plant emerged as the role model plant in Northeast region and safely clocked 1,480 days of lost time injury-free operations as on 31st March 2022. On PY1, the Dispute Resolution Committee recommended a settlement package that has been accepted in principle by both HOEC and government. The issue was related to method to be adopted for calculation of royalty. Terms of settlement require both the parties not to disclose its content. Liabilities arising out of this proposed settlement had been provided for in the books of accounts. Once a settlement agreement is executed and payment limited, extension of PY1 PSC for 10 years will be granted by the government. This brings to an amicable end a long outstanding issue. This would also pave the way for PSC extension and future development drilling to increase production. Meanwhile, ad hoc extensions are being granted by the government. A similar situation prevails in Karsang, where the issue relates to cost recovery limits, as there are differences between the contractor and the government as to the amount eligible for cost recovery. Discussions are ongoing between the government and the operator. This cost recovery eligibility issue is likely to be referred to Dispute Resolution Committee. In our Cambay assets, under approved field development plans, we will be drilling 2 development wells at Asjol and North Balod each. At Palej, ring-fenced PSC has been signed by the JV for R2 area and has been submitted to MOPNG through DGH for final execution. In January, mandatory public hearing was completed as part of environmental clearance process to implement these development plans. In our other northeastern blocks, Keram, Umatara and Greater Dirok, there has been further progress in the regulatory process for forest and environmental clearances. I now invite Jiva to share the financials.
Thanks, Rango. We report that the company made a revenue of 38.24 crores in the current quarter against 36.24 crores in the previous quarter. For the Year-end, the standalone sales revenue is 130.5 crores, comparing 99.44 crores in the previous year. In the Concall accounts, the revenue from sale is 42.21 crores against 43.93 crores in the previous quarter. And for the year 21-22, it is 155.73 crores, comparing 113.86 crores in the previous year. Increase in revenue is mainly from increase in sales price of gas in Assam and higher realization for condensate due to increase in oil prices. The profit on standalone before exceptional is 23.4 crores in the current quarter against 17.6 in the previous quarter. For the year 21-22, before exceptional, the profit before tax is 70.19 crores, comparing 37.47 crores in the previous year. However, after adjusting the exceptional item, the profit for the period after tax is 35.83 crores, comparing 65.06 crores in the previous year. In the Concall accounts, the profit after tax for the current year is 19.95 crores against the 53.46 crores in the previous year. The exceptional items represents rupees 28 crores related to settlement with the Government of India on royalty issue to secure 10 years extension of the block FY22. Provision has been made for an arbitration award against the company for rupees 6.47 crores for the surrendered block CBOS1. We have no amount is carried in the books, which was surrendered much earlier. The total expenses of standalone, including the DDA, is 20.85 crores, comparing 20.59 crores in the previous quarter. For the year 21-22, the total expense is 77.12 crores, comparing 73.79 crores in the previous year. Operating costs are not linear to increase in revenue. However, the statutory levies such as royalty and cess are ad valorem. In the Concall accounts, it is rupees 36.34 crores, comparing 28 crores in the previous quarter. This increase is due to operating cost of floating storage offshore effective to its commissioning on 26th December 2021 and the depreciation thereon. Operating cash flow standalone for the year is rupees 79.58 crores, comparing 52.8 crores in the previous year, which do not include the working capital changes. In the Concall accounts, it is 79.3 crores, comparing 54.24 crores. Outstanding term loan as on 31st March 2022 for the group is 329 crores, and the average financing cost is less than 9% with the cross-currency swap. The total investment made in VAT, including the assets for captive use through its subsidiary, is 955 crores. Delay in commencement of production from VAT causes strain on the cash flow of the company. As stated by Ilango, on commencement of production from VAT, we would be able to solve the working capital issues as well as liquidate the debt at a faster mode than the tenure agreed with the banks. As on date, only about 25% of the investment in oil and gas assets in revenue mode, and the balance would move to revenue mode on commencement of VAT production. This will enable the wholly owned subsidiaries on revenue mode and sustain on their own. We submit that better numbers could be reported on the commencement of production from VAT, which will make the new beginning on, and our focus thereafter would be on the other dormant assets in the company in Western region as well as PY1. Thanks, and back to Ilango.
Thank you, Diva. Anuj, we can open the forum for questions now.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Akshay Shatija from Alpha Invesco. Please go ahead.
Hi, good morning, sir, and thank you for the opportunity. Sir, in our earlier presentations, we've talked about BAT gas production could go up to 15 to 23 MMSCF D. Now, our current contract is 10 GSPL is 10 MMSCFD. So, by when can we expect this this number to go up to 14 to 23 kind of levels?
We've never mentioned anything beyond 15 million cubic feet as far as BAT production is concerned. The sales volume, what we have committed is we expect the production to range between 12 to 15 million cubic feet. We will have our internal consumption of gas, so we have safely made a commitment of 10 million cubic feet. We know the demand in the region is there, and we have the ability to deliver additional volume as well. But overall, limit is 15 million cubic feet per day. Out of that, internal consumption could vary between 2 to 3 million cubic feet, and the rest will be sent on sales.
Okay. So is it fair to assume it will be 10 to 12 million cubic feet around that level itself?
Yeah, at this stage it is fair to assume 10 million cubic feet. That is what we have committed.
Okay. So on second question on this BAT thing, earlier our stance was that we will share 20-22% government with the government, and we'll manage our production accordingly. Right now, with oil prices going above $100 per barrel, does that stance stand? Because at those prices, our production is going to be very low from BAT if we consider 20-22% government share.
I think we wanted to flow the well to its optimum level, and in a way that if the price rise goes, we have to share more revenue with the government. That at the current prices of, if you assume around, say, average price of about, say, $85 to $90 over a period, and we cannot take an aberration prices of 1 month, and say about $85-90, we will be sharing with the government, which is in the order of 1/3. It should be around 33 to 34%, excluding royalty. With the royalty, the government is the more beneficiary to the extent of around 45%. The balance 55% to the consortium.
So we have produced more even if we have to pay more to the government, because earlier our stance was we will produce only up till a point where 20-22% will be shared.
Yeah, the initial operation which happens, we expect the oil price moves to 120 or in the price range for the whole year or something. But we cannot bring the well to the minimum. We have to flow the well to an optimum level. That optimum we will continue to maintain, even if it is a more share to the government.
Okay. Sir, also on that earlier point, we had earlier also indicated that from B2 well, our production can vary from 15 to 23 MMSCF. We didn't commit in terms of volumes, but there wasn't.
No, we have never mentioned that. I clarified. We never mentioned anything beyond 15 million cubic feet from the as gas. Our stance has been consistently 15 only.
Okay. Got it, sir. Okay. Thank you so much.
Thank you. The next question is from the line of Vardarajan from Antique Limited. Please go ahead.
Yeah, am I audible? Hello?
So your voice is coming a little muffled. May I request you to speak through the handset?
Yeah, is it better now?
Yes, sir. Go ahead.
Yeah, so I had 3 questions, in fact. BAT now, what should we take as a, commissioning for oil? Should we take post the weather window or during the time which will happen?
As I said in my opening remarks, the rectification plan that we are drawing up for D1 would require the help of ONGC's dive support vessels, but these actions does not involve lifting of any heavy equipment or can be performed during this weather window also. So it doesn't have to wait for monsoon to be over. It can be performed. Obviously, we would look for the right conditions before deploying the vessel.
Fair enough. Secondly, this premium in the Northeast gas of $1, now that gas prices are at 6.1, so we should continue to take a $1 kind of a premium, or higher than that, or lower than that, on the 40% of the volume?
Yeah, you can continue to take that $1 premium over the current price of 6.1 as such. Yeah.
And volume, should we take it at a normalized level or slightly lower?
No, volumes are also quite sensitive to the price. What we have seen since April is there was a dip in the offtake in the volume, but it is again picking up a bit. So there is a sensitivity linked to that. But mostly in Northeast, what we are saying is it's the shutdowns of the consumers' plant also determine that. But there is certainly a sensitivity. But our contract is tight, meaning anyone who wants to meet their peak demand approach us, and we deliver the gas at the premium over the government notified price that has been established.
Sure. My final question on this PY1. So now, obviously, you will be required to do additional work and all that. And what is the kind of production we can expect? And the existing offtake contract with GAIL, does it stand, or is there a scope for you to enter into a new contract recently developed?
Yeah. The existing contract with GAIL is very much valid and running. We've actually recently restarted the production, the small volume from PY1, just a couple of weeks back, and meeting the GAIL specification. That is running. As far as the increasing the production from PY1, as we said earlier, would require drilling new wells, for which all the technical work has been completed. We have initiated the environmental clearance process, and this would require a lead time of around 9 to 12 months in terms of procuring all the tangibles. So the drilling activity can happen in early part of 2023.
So post that, what is the kind of production we should take? So we should go back to 10 to 15 mmSCFD or lower than that?
No. I think before we face the problem with GAIL on the specification, we are producing a small volume of roughly about 1 million cubic feet per day. That is what we have stored now.
Fair enough. Just a clarification on this entire PY1 proposition. Given that your price is is a fixed price with GAIL, would it even make sense for you to invest significantly to actually produce more at those prices?
No, I think our first priority is to resolve the outstanding issue with the government related to the royalty calculation, which has been resolved now. And this is the first time the government has, through the alternative dispute resolution mechanism, has come to a settlement with any oil and gas company. So that way we are happy that we didn't have to go through the normal legal route and reach a settlement. The first priority is to secure the PSC extension. That should happen. We have now restored the production to a very small level. Overall, I think we've discussed this earlier also. The way we see PY1 is there is unrecovered, there's a huge basket of unrecovered costs, and we have a fully developed infrastructure. So the investment is that of a marginal nature, that where you drill the well, as long as you are able to recover the well cost, there's no other investment is required. Pricing is, once you commit to a price, then you have to live by that contract. That's what we will do. But overall, our plan would be to revive it, but timing of it would definitely, in terms of priority, as I outlined, it would be getting the BAT on full production mode first, parallelly getting ready for investment in other blocks, but do the actual investment only after we are on a full stabilized.
Sure, sir. Thanks a lot, sir. If I can squeeze in one more question for an update on PY3.
PY3 status quo remains. There is the new development plan. We have not seen any activity on the ground, and our attention has been on BAT only.
Fair enough, sir. Thanks a lot.
Thank you. A request to all the participants, please restrict to 2 questions per participant. If time permit, please come back in the question queue for a follow-up question. The next question is from the line of Abdul Karim from HDFC Securities. Please go ahead.
Yeah. Thanks for taking my question. Coming to the Kharsang project, outstanding issues related to the cost recovery limits to be referred to the dispute resolution committee. And the second is the 18 numbers of wells to be drilled in the near future. So could you update on this?
Yeah.
On the both?
First is in Karsang. We participate in Karsang through our subsidiary entity Geopetrol. We have a 25% stake in this. We are a non-operator there. We also have a 50% ownership of the operating company Geopetrol. So all Karsang matters are dealt by the operating company. One, and like every pre-nel block, there are a lot of legacy issues associated with these production sharing contracts, which were signed 25 years back. When the time is coming up for extension, the government is really putting a pressure, pay up whatever was put as a demand by the government, pay up that to get the PSC extension. So, in this case, unlike PY1, where the issue was at least there is a clarity in the different positions taken by us as the contractor and as the government, which relates to the way the royalty should be calculated. In cost recovery, it's a much more complex area where which cost will be allowed and beyond which point, etc., etc. So, what we have said is, as a non-operator, our position has been out of the total amount being demanded by the government, certain portions can be agreed, and the remaining portion can be referred to the dispute resolution committee. But a decision has to be taken jointly by all the JV partners. But all I can tell you is there's an intense discussion going on between operator and the ministry, DGH. By next quarter, we should be able to provide a more clear update on that.
Okay, thank you. And the second question is, you have increased your loan from almost double. So, what is your future plan regarding the loan and long-term borrowings?
We look at the total investments made in PAT is about 960 crores. Out of that, we have taken about only 1/3 is the loan. The balance 66 is internal funding.
Okay.
The BAT commences the production, then we would be able to repay the loan quickly thereon. Then every assets, we don't want to borrow more than 1/3 of the capex required. So our major investments next we are looking at only from PY1. So we will be able to raise some element of funds actually, which may be either a debt or equity as the case may be. We have no plan at the moment, but we are banking on the BAT revenue. If everything subject to the commencement of production and the price holding it, we would be able to have a cash flow which is in the order of around 500 crores. We should be able to meet with the requirements.
Okay, thank you so much.
Thank you. The next question is from the line of Rikesh Parekh from Barclays. Please go ahead.
Thanks for the opportunity and congrats on getting the BAT operationalized. So my question is on BAT. With this new development, sorry, I joined late, so might not be aware of it. But what is the kind of complication in D1 well, and what are the current volume? Means we had estimated 8,000 barrel of oil equivalent per day. So with only D2 operational, what should be the kind of oil we can expect for to be operationalized, which is operationalized?
See, the number that we have indicated as a total for both wells put together is somewhere between 7,500 to 8,000 barrels of oil equivalent. Out of that, the oil component was somewhere between 4,500 barrels to 5,000 barrels, and the gas component to constitute that 2,500 in terms of oil equivalent in terms of gas as such. Right now, the gas that is the well that we have brought on production is predominantly gas. It also produces a little bit of oil. We just started few days back, and we'll be monitoring the volume that come. Now, whatever volume, little volume that we produce along with the gas, we've already we're able to export that into our FSO for storage purposes. So we have done the transfer of this oil into FSO. Through that, we have tested the whole system as well. So if the total volume would really depend on by when we are able to bring B1 into production. At this stage, we don't have a specific date to commit, and all I can assure you is we will make every attempt to bring it on stream as soon as possible. As I said, this will require underwater operation involving ONGC vessels. So as soon as we bring it on board, we will make an announcement about that. So until then, it is basically the gas well. As I said, gas well from a revenue point of view, what you need to consider is 10 million cubic feet. Right now we are producing at a lower rate, but we will be able to ramp that up to ensure a sale of 10 million cubic feet.
Okay. And second thing is regarding this Tirop field, we have seen a reduction in the offtake over there. So do you think that at higher prices the offtake is lower over there, and even the existing partner Oil India, who is being the first consumer, so they are taking on the lower price as such? How should we take it as such?
Yeah, no, I think you're right. There is two factors are at play. Number one is obviously all our customers have got access to Oil India gas as well as that of Tirop gas, all the customers. So their first choice would be to exhaust their volume from Oil India, which is always at a lower price. But we have been able to successfully position ourselves as a peak demand supplier. So every company with every company we have managed to tie up the contract, and they know that whenever there is a demand increase in their plant, we are there to supply them as such. And certainly, not only in Northeast, we are seeing at all over India, the Indian consumer is very, very sensitive to the gas prices. So there is a certain percentage of that is strings by the price sensitive customer. That is one. The second thing is, what we also observed is whenever there is a shutdown of a major player like BCPL or MEPCO or any other major player, there is a straight away offtake gets reduced. So I think what we have seen is we've seen in the current quarter also a slightly lower offtake, but it has started picking up decently. We'll have to really wait and watch. The third development is earlier we were the only private supplier in Northeast market. Right now there are other couple of players who also come in supplying in different regions, both Vedanta and Oilmax. So all this will outplay, and we'll watch all these developments before we make further investment in drilling additional wells. The good news is our wells are producing very well, and we feel the reservoir is of excellent quality. We'll be able to meet the demand of the market, but it's very difficult for us to generate demand in the market. We will play to the demand of the market.
Sir, one more additional question related to the previous one. So since I understand from the fact that we have got approval from the forest department for the increasing the output. So let's assume whenever this we increase from 35 mmCD to 50 mmCD of gas, would we be able to have a captive demand for that, for the additional output?
The way we are planning is, one is the Tirop field development plan phase 2, which has already been approved, really involves two components. One is to drill additional wells to increase the production, and the other is to create our own infrastructure, which is the pipeline infrastructure, which passes through the forest land. This is the second component. So we are keen to really continue with the pipeline infrastructure, which will help us to directly deal with the customers, multiple customers, and have the flexibility. Also de-risk our dependence on Oil India's very old pipeline as such. So that's how we see that. So we have got the stage 1 forest clearance, stage 2 should be coming through. As far as drilling of well, there are 2 ways. We have already demonstrated the existing wells has delivered up to 42 million cubic feet per day. That's our first milestone to ensure with the existing wells we deliver the market demand. If required, we can always undertake a workover operation which will involve increasing production from existing wells. If not, we always have the flexibility to drill additional wells. So we will take these investment decisions in a phased manner, but we'll always be ready to meet the demand of the market. Now, your second part of your question, as far as the demand is concerned, we expect the major demand to really come in Northeast once the Numaligarh refinery expansion project is completed, which I believe is on track. That project completion would significantly increase the demand from a premium customer like Numaligarh refinery.
Okay. Sir, one last.
Sir, sorry to interrupt you. Can I request you to come back, please?
Sure. Thanks.
Thank
I'll come back.
The next question is from the line of Sunil Jain from Nirmal Bang. Please go ahead.
Yeah, thank you for taking my question, sir. My question relates to BAT. Regarding D1 well, can you say how technically it is difficult to correct the problem or anything on that? Like, will this well, you are sure that will start production?
It is technically difficult to answer this question seriously because we have in consultation with the OEM and the experts came up with a solution that worked in D2, but that did not work in D1 after pressure was held for some time but did not subsequently work. So we are consulting the experts to make definitely one more attempt. And what is the good news is, earlier we thought certain type of operations cannot be undertaken during the monsoon period, but the nature of solution that we are looking at can be executed during this window also. So that is our effort. It's very difficult to really predict the outcome.
So if suppose D1 this corrective action what you are planning doesn't work, which has not worked in the first attempt, so doesn't work, then what could be the course of action thereafter?
So the course of action is to continue the production from D2 well, gas well, and take a overall review of everything, subsequently, which would involve, lifting certain equipment to the surface and rectifying it. As he said, there is no problem with the wells per se. There is no problem at the mobile offshore process plant also. To a layman example, this is like a TV is functioning well, but the remote alone we are having a problem. So we don't see it as a major issue. At the same time, if the whole umbilical system need to be lifted, that can only be done through post-monsoon. But please give us a couple of, some more time to make another attempt. The good news is it can be done during this period, and as soon as the results of the attempt, we will update you. Time is only a factor here.
Yeah. And sir, another question related to this is that what is the fixed cost which you need to pay as a cash outside per month during this period, and what could be the capital cost which you may be incurring on doing all this activity, rectification?
So you are talking about the future capex for this repair works?
Yeah.
That should be about less than $400,000.
And the running cost of gas operation means will there be government this royalty or government on, because gas I think is not attracting that.
Now the gas we have to pay the royalty, And this is being a revenue sharing contract. Whatever the revenue shared, actually in proportion to it, whatever the quoted rate for us. So roughly about 55 divided by the million, that is about, so say 54%, multiplied by the proportion to the $1 million to the revenue. So roughly around, say, if there is, my revenue is 100, I'll be paying to the government, which is in the order of, say, 20.
Okay. And apart from that, cash running cost will be for the whole, what was earlier you had predicted around $15 per this thing, or it will be lesser?
What is happening, it is more of a captive plan for us. Only that 40% we have to share with others. So if you look at an open and transparent model as such, we will be having our cost is about, say, $125,000 a day. So it would be more economical and meaningful if we start the oil well also on production. If we start only with the gas well, we will be making some money as such. But all our MOPU and FSO would get paid. And we'll have still some money, small amount of money, which we can share with the government and to the partner there.
Okay, so
have a full production from the field as such.
Okay, great, sir. Thank you very much for answering.
Thank you. Next question is from the line of Riddesh Gandhi from Discovery Capital. Please go ahead.
Hi, sir. So congratulations on starting of the gas well. So you just wanted to understand, given the now, reasonable amount of free cash flow we're going to be generating out of Assam and the gas block and the oil block, if you could outline to us the future plans you have with regards to sort of optimizing the production out of all of our assets, given the current oil and gas prices and the environment right now.
See, we have to come out of the working capital issues at the moment. That is our first priority. Once that is done, actually, the next priority is to bring down our loan in a manner that it is not strained us at any moment or anywhere, though it is about less than 9%. Then you look at now the Iraq, it will be a self-sustained unit, because even if you wanted to ramp up to production of 55, that can be done with the existing wells. It is a small capital involved. Our major capital expenditure would move to FY1. That would be our next priority. And parallelly, we will be moving some investments to the western region. This is the way when we have a free cash flow, that is our priority. First is the working capital, come out of it. Second, pay off some debt. And the third one, put some money onto the FY1, redevelopment we call it, and then to the western region. This is our priority of expenditure.
And the other question was with regards to, do you see any risks with regards to the production from D1, or is it just a question of the timing as opposed to, effectively speaking, any a risk with the actual production outcome?
That one thing I would like to submit, we are all talking about subsurface, so this will always entail with some risk, and we cannot say it is a risk-free by any means. With a caveat toward having a good technical team and their understanding is good and we are able to execute the project well, these are all already a proven blocks and having the oil and gas established in that field, and we will be able to produce. That is our confidence level. But at the end of the day, the risk is there with all the blocks which were being operated under, because the production comes from the subsurface.
Got it, sir. So, and the last question is with regards to when do we expect the commercial production to start from D2?
Yeah, as Elango already explained, now the land packing is going on. He is going to have a discussion with the ONGC. Once that is sorted out, because it is a long line, that is after that, the moment we commercialize the sales, we will inform to you as a matter of our compliance.
No, but is that expected to be, is it a question of, 2-3 weeks? Is it a question of 2-3 months? How should we be looking at it?
It's not in months, but it should be in weeks.
Correct. It's a
Okay.
question of weeks.
But is this an agreement we need ONGC to sign off on, or you just wanted to understand the reason for this and any risk associated with this?
No. This agreement has been finalized as far as the overall transport agreement has been finalized with ONGC. There are no issues around that. We just need to take their help in how we could expedite this packing and what can be done. That alone need to be discussed. So we don't see any issues, Ritesh, on this.
Okay, so thank you and all the best.
Thank you.
Thank you. The next question is from the line of Rohit Pothi from Marshmallow Capital. Please go ahead.
Thank you for the opportunity and congratulations on beginning production from BAT. My first question again is on BAT itself. So you mentioned that it will take some time to ramp up the production to 10 MMSCFD, and you also mentioned that the pipeline is a little old. So is there any risk to the pipeline itself, or it's already been tested and you don't see any risk to supplying of gas from BAT to wherever the customer location is?
No, we don't see any risk as far as the pipeline is concerned. This is a well-maintained pipeline of ONGC. What I really meant was ONGC had not charged this line with gas in the past because one of their field was not ready. Otherwise, it is a very, very well-maintained pipeline. There's absolutely no issue. What happens is, when you initially introduce the hydrocarbon in a line, you need to pack the line before it. Please remember, from BAT to Hazira, the distance is roughly 150 odd kilometers pipeline. Now, it has got two sections. One is a section up to what we call WO platform of ONGC, which has not been charged with gas in the past. So first time gas going into the line is from BAT. The other section of 100 kilometers is what is one of the largest pipeline network which delivers gas to the HPJ pipeline of GAIL. So there's absolutely no risk on that. It is just basically reaching an agreement with ONGC on how much of BAT gas could be packed in the line and seeking their request to place some of their volume also here so that we can monetize quickly. And we do expect ONGC to fully cooperate with us as they've always been during all these challenges that we faced.
Okay, this is very helpful. So just a follow-up here. So you mentioned in your comments that it will take time to ramp up to 10. So is it because you want to test our systems properly to ensure that there is no loss of pressure like last time, and then you'll ramp up? Is that the reason?
Exactly. We just wanted to ensure the well is brought slowly online and testing each of the subcomponent as well as for ONGC to receive. It starts with a slow number and go up. We don't see any problem at all in the well's ability to deliver the 10 million cubic feet. It's just the surface system need to be taken at pace safely.
Okay, so basically what this means is that it will take a couple of weeks a few weeks for commercialization with ONGC, and after that, how long does it take for you to? It will be in this quarter itself that we'll reach the 10 MMSCFD. Is that the right thing to think? Is it the right way to think about it?
Definitely.
Okay, perfect. So my follow-up question, the last question is on DROC. So when Jiva sir mentioned the priorities for HOEC, so this year it looks like primarily we are looking at managing the working capital and reducing debt. And then he talked about the Western and PY1. But so what's happening with the DROC, the alternate pipeline that we are planning to lay? So is that below the priority list, below PY1 and Western region in terms of priority list, or is it the next thing that we'll be looking at in this year or the next year?
What I said was that our people have done, considering the reservoir performance, we have 6 wells in the field. The 6 wells can itself, with a little workover, can meet the demand therein. So that's the reason there is, even if you infuse the capital therein by drilling additional wells, there is you need to have a demand to supply for it, right? So that is the reason when the existing wells can do it, these capital can be deferred till the demand is built up.
So that will take about a year so, but 1 or 2 years. Then drilling those wells will not take more than 3 to 4 months. So we will be able to quickly ramp up the production if required. So, but putting the pipeline is a small venture, small capital items, which is our share is only 27%. The other partners are willing, that can go ahead. That is not a very high capital intensive project there.
Okay, perfect. So just to confirm, so the existing wells can produce, it has produced a peak of 42, but can it produce 50, 55, or for that we need additional wells?
So with the workover, our geologists are confirming that they will be able to go up to 50 comfortably. Yeah.
Okay, fine. Thank you, sir. I'll get back into the queue.
Thank you. The next question is from the line of Tejas, your Munich Stockbroking. Please go ahead.
Yeah, hi. Standard first general complaint what we have is there is no communication from HOEC regarding any.
So sorry to interrupt you, there's a lot of echo coming from your line.
There is no confirmation or on your lines in terms of any communication to the exchanges for the gas production or anything. Now you are saying 30th the production started for the gas or you're connected. The price after the result next day jacked up by 15-18%, but market is not aware. You are declaring it today that 30th the thing has started and the price is already jacked up. Even whenever we complain or whenever we mail to Dolphin, there is no communication at all saying we cannot disclose what is happening. There is absolutely no communication from your side coming. If you can throw some light on that.
Yeah. First of all, just to clarify, we achieved specification of gas and injected into ONGC pipeline on 31st May, not on 30th. 30th we declared the result, and 31st May only we could achieve the specification. Until then, it is about commissioning the system. There is no commercial production. In fact, we would have ideally liked to have commenced the commercial sales and made the announcement. But having this call, we thought we should disclose the current status as such. Now, for us, two things are important. One is to comply with all the requirements of disclosure as and when a major event occurs, which in our assessment has a clarity and certainty. That is one. We have never diverted from that attention. Obviously, in calls like this, which we hold at every quarter, we are able to explain in much more detail to every participant. Please understand these are technical in nature, and as long as I have a certainty of we have no about discourse. We are
sorry to interrupt you. Tejas, can I request you to mute your line from your side, please?
Yeah, it's mute only.
So when we are, what I was saying, and this is I meant it for every other audience and participant who may have this issue. So what we thought was, whenever we are certain about certain outcomes, then it is easier for us to communicate that. When we ourselves are not very certain, we just focus on the operational matters and ensure whenever there is we achieve complete an activity, we make the disclosure, and we will continue to do so.
Agreed, but a request. See, even at the time of Velodrome Advisors, there was your 31st last day, the management backed out, and there was a notification saying the production will not start because of whatever delay, and the price fell, and the management did not come for any explanation at all, and not on anything. So even at that time, the investor lost money.
I respect your questions, but you're not dealing with a management which will ever back out from anything. We are very determined to meet all the promises we made. We are doing our very best to achieve that. And on communication, I told you we would, whenever we have a certain information, we will definitely make the announcement.
Thank you. Tejas, may I request you to come back in the question queue for a follow-up question?
Okay.
Thank you. The next question is from the line of Vaibhav Barjatia from HNI. Please go ahead.
Yeah, thanks for providing the opportunity.
So I just have two questions. One is on the rock field. So what is the minimum production we will like to continue, given that there might be a possibility that if production falls below that level, maybe because of the demand level or something, coming back again to the optimal production might be difficult due to the nature of the field. So what would be the minimum production that you would like to continue at the rock? That's the first question. Secondly, on BAT, so is it the problem that BAT faced has anything related to the fluctuation in the production from the wells itself? I mean, the fluctuating pressure or fluctuating production in the well created this problem, or it's the problem related to the equipment itself or any other services related to the equipment?
No. Okay. As I clarified, there is absolutely no problem with the well per se. In fact, he also tested the D1 well for a very, very short period and brought the oil to the surface also. So we don't see, and our technical team is able to monitor the pressure in the well even now, remotely. So there is no problem as far as the well flow or productivity of the well is concerned. And where we each well, I'll try and explain. Each well, to open the well, it's kind of a remotely operated system. Please understand, these wells are located at 80-meter water depth, and you have what we call the Christmas tree and below the water. Right? It is very similar to the deep water developments. That's what you see. So everything is operated remotely from the surface. To open the well, you need to pressurize what is called a hydraulic actuator line through a hydraulic fluid. I emphasize it is a hydraulic fluid, which is water-based chemical. When we pumped that into this tube, it was not holding. So without that pressure being held, the valves will not open or will not be kept open. We are able to open, but we are not able to keep it open. Just to help you understand, if you're trying to open a window in a beach-facing house, you need to keep a pressure on the window because the wind is coming from the other side. It's a similar analogy. So we have so we are able to open. We in fact flowed the well, D1 also, for a very short period, but then the pressure losses, the well will close itself. This is the system. So our attempt would be to just go and see whether this pressure loss could be identified under a 80-meter water depth. These cannot be performed by normal divers. It requires what is called a saturation divers. Fortunately, ONGC has vessels and divers, and they've been very, very helpful among all their priorities to lend these vessels to do our operation. So we are also consulting them. So this is, I hope I'm able to clarify a little bit, but this is what the nature of the problem.
Got it. Understand. And the second question on the DROC, if you can answer, that would be helpful.
Yeah. In DROC, what we've seen, as you've seen the number in this quarter, which is, about 27 million cubic feet per day. This quarter also we saw some lower offtake. And the April will be the first quarter at the new price point. We saw a lower offtake, slightly lower offtake in April, but people are coming to realize this is the price on which you will get. So we have seen recently, just in in a week or so, demand picking up. So I would expect the average we should be able to definitely achieve about 25 million cubic feet, if not more.
Yeah. Sorry, but my question was not around what we can achieve or what. So basically, generally in some of the fields, there are issues that if the production falls below a particular level, then it becomes really challenging to bring it back to the old level. So I just wanted to understand what is that level in DROC.
We have no issues of that kind as far as DROC is concerned. We have the flexibility to take the production, as you have mentioned, 42 without anything, million cubic feet per day, and with workover up to 50 million cubic per day. So we are just positioning ourselves. As long as the demand is there, we are able to quickly ramp up and ramp down the production, and the reservoir is a good quality reservoir, we see no problem at all.
Okay. Okay, understand. Okay, thanks. That's it from my side. Thank you.
Thank you. Next question is from the line of Jaisal Shah from Laser Securities. Please go ahead.
Yeah. What is the Indian value for gas from D2, which will be there for 10 million cubic feet, what you are saying? And expected revenue profits out of that?
Can you repeat the question?
From the D2 well, the expected sales is 10 cubic feet or 10 MMBTU. What will be the Indian revenue that we are targeting out of which, and what will be the profits coming out of that? Because you said some 100 is the cost and 20 is what you will need to share it with the government as royalty or whatever. So, but what is the value on that?
Say, actually, we get the full flow of the 10 million cubic feet, and our price was fixed in terms of the Brent equivalent, and some 22% of the Brent. But till the time we reach that 10 million, even if you take the lower price, say around $15 per MMBTU, and we would be able to make a revenue which would be in the order of say 250 crore, somewhere around 225 crores. That should be the revenue base. Out of that, 25% goes to the Government of India. So the balance meets an operating cost. We'll still end it with a profit of about some 75 to 80 crores.
Okay, around 75 to 80 crores. That is per annum you are saying, correct?
That's right. For annualizing to this year.
Okay. And if you can clarify on the royalty part, for the D1 you said, if the oil is around $90 or odd, 34% will go towards some extra royalty, and total royalty will be 45%, and plus your expenses in the tune of $15 to $20, or how exactly?
No, can I clarify that? See, it's a revenue sharing model. In the revenue sharing model, it is whatever the revenue you earned that has to be shared with the government. It's the agreed predetermined rate. What the rate we accepted is LRR and HRR is varying from 12% to 55%. So in that context, if at a $90 oil price, if I make say 4,500 barrel of oil and say about 10 million cubic feet of gas, I have to share with the government 1/3 of the revenue as a revenue share. On the top of it, whatever the value I am realizing there onto it, 10% would be called as a royalty, which is ad valorem. It is not fixed. Okay, so the revenue share to the government would be about 40 to 43% on the revenue. The balance is for the operating cost, and the rest goes to the companies for sharing it.
Okay, and the operating cost is what, around $15 or $20 for the oil?
Operating cost for the field we are expecting, which is our captive, two subsidiaries are holding the major assets, which is one is the MOPU, another one is our floating storage offshore, and the single point mooring. This is owned by us. So these companies will take a revenue which would be in the order of say $95,000 per day. And putting together the helicopter and supply vessels and all, we should be in the range of around $125,000 a day. Out of that, resource generated and which comes to the group is about $95,000. The balance goes to third parties.
Thank you. Gentlemen, may I request to come back in the question queue? Thank you. The next question is from the line of Nirbhay Mahaval from N Square Capital. Please go ahead.
For the opportunity and congratulations for the commencement of VAT. So with the commencement, we must be aware of the dynamic data, and we must be more informed on the quality of reserve as well as field life. So what is our sense on that?
We will, as you said, we were able to flow the well since 31st May now, last 2-3 days. And the pressures are as per the earlier testing results as far as D2 is concerned. D1, we have flown it for a very short period just to test the system. As I said, the important aspect our technical team look at is what is the pressure being held by the well, and that is as per the expectation. So we remain confident that we'll meet the tested numbers, which was oil is about 4,500 to 5,000 barrels per day, and gas about 12 billion cubic feet per day.
Sir, any sense on that field life in terms of number of years? What is any better sense on the field life data?
I think we have there are three things, that we will be able to do the material balance again after putting a production for a year. So our current estimates goes, there are three values are there: P90, P50 and P10. And if you look at that P10 case, we will be going to the entire contract value, that is about 20 years. And P50 we should be able to produce from at least 10 to 12 years. And in our all probability, the minimum duration of 7 years we will be completing in the P90 case.
Right. Sir, now we have got a lot of low-hanging fruits in our in terms of the existing reserves we have got for Kharsang as well as PY1. So from balance sheet point of view, when do you see you will be able to open a new field, and you will be able to? Do you see this happening in FY23 only? Like PY1 in ramp up?
I told you already that we have to come out of our working capital issues and some repayment of the loans, and we wanted to leave it to the minimal level, and after that we will embark on the development. Our first priority of development is PY1, which is already a sunk capital of $383 million sitting there, which we wanted to bring back to some value on these assets, and then subsequently we will embark one by one.
So how long do you think, with the cash flows of D2 at least, when do you see this starting? Investment in this starting?
So it is all projection, subject to the caveat of DIT comes on stream and we have the revenue generated thereon. Our PY1 initial planning process has been completed. Our geologist has come out with the location, and our drilling manager is making a drilling plan thereon to it. To execute there, it needs about actual drilling and completion of about 3 months. And however, subject to the availability of the rig at the right price. So any vessels moved into the West Coast, we'll keep an eye on it. And if we have the capital at that point in time, we will be trying to commence the drilling thereon. So we wanted to do the work at cost as such, and we don't want to do at any cost as such any development in future. So we wanted to be careful in future on that.
Thank you. Nearby, may I request you to come back in the question queue for a follow-up question?
Does it make sense to bring in any external...
Nearby, sorry to interrupt you. May I request you to come back in the question queue for a follow-up question?
Thank you.
Thank you. The next question is from the line of Ashwin Reddy from Samatva Investments. Please go ahead.
Yeah, good morning, sir. Thank you for the opportunity, and congrats on getting BAT on board. So firstly, regarding the rectification plan, and if that fails the subsequent plan that you had outlined, which would happen post the weather window, what would be the amount of money you would need to spend on both these plans? And because the reason I ask is you mentioned about the working capital issue and the liquidity issue and all, and recently we also saw the pledge of a pledge as well. So in that context, I wanted to understand how much money do we need to spend on these plans to get the T1 cell on board in both the cases?
These operations essentially involves hiring the vessel from ONGC, which has a full complement of equipment and diving team, and we put our own team to supervise the job. So overall, the estimate is about $400,000 for this operation, which we made arrangement.
Sure. Sorry. But this is the rectification or for the overall thing that you said, in case the rectification fails, the post-monsoon activity, if you have to overtake, what would that cost?
Yeah. Now, this is for the rectification that we are talking. during the monsoon period.
Okay. And if it is post that, how much would that cost?
If you have to do the full basically this is a subsea system. When the system works, there should not be any problem. And even if the post-monsoon, it should be work which you wanted to do the whole system and come back and doing it. It should not cost you more than 10 to 12 crore rupees. It's about $1 to $1.5 million, the max exposure. But I don't think if it is holding as such, then we don't need to spend so much of money on that. But anyhow, that's overall capital we incurred, which is in the order of say $125 million. This is less than 1% of the work which we have to carry it out.
Thank you. Ashwin, I'll request to come back in the question queue for a follow-up question. I request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Manan Patel from Airawat Capital. Please go ahead.
Thank you for the opportunity, sir, and congratulations for pre-commissioning of BAT. $95,000 per day comes to the group and $125,000 the total operating cost. So that comes to around 340 crores. So does that start as soon as the production is started, or like it is linked to the commissioning of D1, D2 and other wells?
See, normally it is on the commercial sale. That is a relevant date for us. See, whatever the time which we spend, we may produce some oil or we produce some gas. Till the commercialization takes place, the date of commercial production is considered to be the date for the commencement of revenue to us, which can be either oil or gas, whatever it is.
Okay, so the cost is also related to that.
Yeah, that's right, because for this the operating cost related to that. Because without these facilities, neither the gas nor oil can be evacuated. So day rate starts on the date of commercial sale of this plant.
Okay, got it. And the second question is, today article related to DSF3 came, but your HOEC was not mentioned in that article. So are you not participating in DSF3 at all?
Closed. Yes, we have not participated in DSF3. We thought we would focus our attention on BAT, bring it on full stream, and then look at opportunities within our portfolio where, as you said, there are several low-hanging fruits within our portfolio. We would focus on them, invest, and then look at other opportunities in future only. We didn't want our attention to be diverted in anything other than BAT.
Okay. And sir, lastly, can you just throw some light on why was the pledge done? Was it personal reasons or for what? Or was it for the company itself?
Not for personal reasons. I lead a simple life, so I don't need that much money.
Okay. Thanks a lot, sir. Very helpful. And all the best.
Thank you. The next question is from the line of Rohit Balakrishnan from iThought PMS. Please go ahead.
Yeah, hello. Am I audible?
Yes, sir. Yes,
please.
Yeah. Thank you for the opportunity, sir, and congratulations on getting BAT started. So most of the questions have been answered. Just a few clarifications and follow-ups. So first was, sir, that assuming that D2 gets commercialized, which you said should happen in a few weeks, what is the kind of revenue that you mentioned that you can sort of do in this year, which will accrue to HOEC? I missed that number, so if you can just...
Yeah. I think, subject to the caveat on D1 comes back to production. We will start with the production of 2,000 barrel and ramp up to 4,000 barrel, and it can further ramp up also. It will be a slow process. We will be keeping the system tuned towards to receive the oil to its capacity of the well. The test production of this well is more than 5,000 barrel, but we will be reaching to a number. The plant can handle it in a comfortable manner as such. So till the time we will assume an average production of say 4,000 barrel a day.
So you can multiply the 4,000 barrel into the price. Price I cannot determine as such. Today it is holding 120 and tomorrow it may go to 90. And if an average price of, you can take it as $100, it is $40 million. It can make 300 crores actually.
Right. So, sir, this all this map that you mentioned is only considering D2, right? It's not considering D1. Is that understanding correct, or?
D1 is D1 is on the production mode at the moment, but D2 is in a production mode at the moment. D1 is an oil well,
Right.
and that we have to put it on production. So the repair is being carried out, and once it is successful, and we would be able to ramp up the production from starting with somewhere around 2,000 barrel, and it is having a capacity to produce more than 5,000 barrel as seen from the test results. And we have to tune the plant in such a manner it is comfortably able to receive and process the oil to that extent. Then accordingly we will increase the choke size of the well. So on an average, if you assume a production of 4,000 barrel, we will be making revenue depending on the price prevailing after 2 months of production, because minimum of uptake size is about 200,000 barrels. So once we reach to a size of 200,000 barrel, then we will be able to sell that oil. So it takes a lead time of about 2 to 3 months.
Sure. Actually, sir, my question was from the point of view that, let's say D1 well takes some more time, then what kind of cash flows that can we get? That was the question. So basically you are saying that even if D1 takes time, D2 can give us these kind of revenue and cash flows.
I'll tell you, this is a caveat on two things.
Sure.
One, the production sustenance, demand sustenance, price sustenance, and with all these things are happening, we will be able to have a cash in hand which is in the order of around 400 crores to meet our the working capital demand, meet the repayment some of the debts, and as well as for embarking on the new capital thereon.
Right. So, sir,
Sorry to interrupt you, sir. May I request you to come back in the question queue for a follow-up, please?
I'm just sort of just a clarification. If you can just complete this and then I'll join back. Is that okay? Thank you. So, sir, my question was just to, in a unfortunate scenario, or in a scenario which is not expected right now, but D1 takes a lot of time. Will the cash flows from D2 elevate the working capital the working capital issues that we may have? Will those be solved? That's what I'm trying to understand. So assuming obviously the price, whatever we have, the price holds and the demand holds. So
yeah, I think we should be able to have no working capital problem after the commercialization of D2 gas sales.
Right. Okay, sir. Thank you very much, and all the very best for the remaining portion of BAT.
Thank you so much.
Thank you. The next question is from the line of Karthik Sharma from NVS Brokerage. Please go ahead.
Thank you for taking my question. I just have one question in two parts. How do you see the volatility in the oil markets, and what would be the realization for that in the company? And do you see the fuel prices to remain firm? And the second part is, what would be your take on the volatility on the prices?
So overall, we are seeing, whenever there is a higher prices, particularly the gas price at a higher level has a tendency to distract the demand, destroy the demand as such. That is what I understand is certainly the Indian consumers are very sensitive to the price, and the current price level, there is a reduction in demand across as far as gas is concerned. Oil is really it's difficult to predict. What really happens is...
Sir, I'm sorry, I couldn't hear the last part. I don't know, there was some disturbance from your end, I believe.
Okay. No, I was saying that Indian consumers, particularly talking about the gas, are very sensitive to the gas price, and there is a reduction in demand at a higher gas price points as such. So that is across India that the demand numbers are reducing at a higher price point as such. As far as the oil is concerned, your guess is as good as my guess. The scenario what we see and read is the price is going to be at 3-digit levels, but things could change dramatically. So we on oil price, as you were saying, we always are looking at around $75-80 in all our calculations, probably 80.
Okay. Thank you. That's it. The rest of my questions were answered in the questions asked by the participants. So that will be all from my end. Good luck for your BAT production in the future.
Thank you. The next question is from the line of Pankaj from Varuna Investments and Finance. Please go ahead.
Hi, sir. I just wanted some little knowledge. On DROC, you say your production is 27.7, that is equivalent to 572 BOEPD. And as far as BAT is concerned, you say it's going to be 10 million. So what would your BOEPD equivalent on that be?
Now, first of all, in DROC, that is the number reported is 27 million cubic feet of gas per day, as well as 500 and odd barrels of condensate. That is not a converted number. It is straight away liquid numbers only. The 10 million cubic feet of gas will be equivalent to about
somewhere around 1,650 barrel of oil.
1,650, but it is in volume conversion only. So don't apply any price to that.
Okay. So that because your business is so complicated. I mean, you've got profit sharing and profit petroleum, and so laymen like us really don't understand too much. I mean, thank you for being patient over the on your con calls, but at the end, I don't think any of us really takes anything much home. So what we want is how is it going to impact my share price. So that's the key figure that we wanted to always find out. And what we find that coincidentally all your trigger points in the company's last 2 quarters has been on the last day. So that leaves a little bad taste in the mouth about the reporting part. I mean, nobody's putting any blame on anybody, but I would believe that look at the sensitivity of the information that is there, and it's not a question, it's just a commentary that I'm making, that an earlier speaker mentioned it. So it leaves a bad taste in the mouth when you come out with the results on the 31st or 30th, and then you wait 1 day or 2 days to share it with the investors through a presentation like this. So not everybody looks to come to presentations. They look at more the basic information that comes out with the results. So on the day of the result, I'm sure you could have probably put out a little caveat on how things are. So then probably it would have not pinched us so much. So that's the only thing.
No, I appreciate your comments. I just want to say one thing is, as a shareholder, you would obviously be looking at the share prices. All I can tell you is, as professionals, both me and Jiva really never look at the share prices. We just focus on the job that we have in hand and do our very best.
Thank you. Next question is from the line of Vignesh from Sequent Investments. Please go ahead.
Yeah. Hello, sir. Yeah, most of my questions have been answered, but just 1 or 2 clarifications if you could give me on one of the gentlemen who asked you about the possible revenue or the free cash flow. The 300 crores revenue that you quoted subject to $100 pricing and the current demand sustaining, is it only from D2 well, or it is including D1 oil well?
See, sir, the total as such, what I told is the total number as such.
Yeah, means from this, so it's only from D2 or it's entirely from BAT, all in total sum?
From the D2 alone, it needs the D1 also comes to play.
Okay. And the similar thing for the free cash flow, right, of 400 crores. Hello.
Yeah, that's right. You were right.
Yeah. Okay. That's all from us. Yeah.
Thank you. The next question is from the line of Dharmendra Vora from Vora Family Office. Please go ahead.
Yeah, my question was regarding the analogy you have given of a television and a remote for a layman. I just wanted to understand, suppose the current resolution with the ONGC team doesn't work out during this monsoon period. So what is the next course of action when the vendor window permits, and what is the timeline probably, and what is the cost timeline regarding the commissioning of the D1? That is the first question.
Yes. I think if this doesn't work out, as you was mentioning that this is not a major equipment. This is an umbilical system where we know for almost 70% of the system is working absolutely fine. There is a component which can be lifted to the deck of a vessel, which can be performed during monsoon period and replaced or reconnected with the presence of experts as such. That's what needs to be done. And that cost we've estimated to be in the order of $1.5 million, and that can be performed immediately after monsoon, which is sometime in October, November period. If our other attempts do not succeed, we have every hope that our solution will succeed, and these attempts cost us about $400,000 to mobilize, and which we will be doing.
And what are the risks involved? Suppose this first attempt fails during the monsoon. What are the risks involved? Are there any other unspecified risk which might crop up at that point of time apart from the cost involved? Are there any distinct possibilities of entire thing not working in our favor?
Now, we've seen it work. We have seen both the well produce. We have seen both the well come to the MOPU very clearly. Therefore, we don't see any other problem as long as we are able to fix. If we are not able to fix the problem in D1 well, we will not be producing from that. There's no other risk. And we'll continue to produce from D2.
Thank you. The next question is from the line of Dipen from DS Investments. Please go ahead.
Yes, sir. Thank you for the opportunity. It is just a reiteration of what you said earlier. Now, we totally, the B80 total has a capacity of about 7,500 to 8,000 barrels of oil equivalent. Currently, we are producing about 22% of that, which is about 1,700 barrels of oil equivalent. So this we will be commercializing probably by the end of June, and we will start receiving revenues from the end of June. And the balance 80% of the production, we hope to start in the next maybe 2 or 3 weeks when this issue gets solved, and if not, maximum by October, November. Is this a right understanding?
Yeah, that's a correct understanding. I just wish to clarify the capacity part that you mentioned, that we expect both the wells together produce about 7,500 to 8,000 barrels of oil equivalent.
Correct.
The capacity that we have built is with future in mind, that individually we have the capacity to process 10,000 barrels of oil and 15 million cubic feet of gas.
Okay.
These have been kept, this capacity has been built on the top side so that in future when we do new wells or find the wells to be producing more, we are not constrained by the top side capacity.
Okay. Okay.
So your 32% analogy may not be correcting, but your 1,700 barrels of oil equivalent vis-a-vis 7,500 barrels of oil equivalent is the correct reference.
Okay, sir. Understood. Balance questions have already been answered. Thank you very much and all the very best, sir.
Thank you.
Thank you. The next question is from the line of CS Chaudhary from CSF Financial Services. Please go ahead.
Yeah, good afternoon. Can you hear me, sir? Hello.
Good afternoon.
Yeah, good afternoon. Firstly, this is a question to the management as such.
Chaudhary, sorry to interrupt you, but your voice is breaking very terribly.
Okay.
So may I request you to rejoin the queue?
Yes. Okay.
Thank you. Next question is from the line of Sai Das, individual investor. Please go ahead. Sai Das, may I request you to unmute your line from your side and go ahead with the question, please?
Am I audible?
Hello.
Hello?
Yes, please.
My question is regarding the B2L. So, on a standalone basis, you mentioned that D2L, at USD $15 per MMBTU, will generate a revenue of 225 crores, and 25% of this will go to the government. So, is this 25% a fixed number, or more or less, or will it increase? And that's my first question. And the second question is, you using these estimates, you said that the profit would be around 75 crores annualized. So this 75 crores involves the expense, the money that you receive from that MOPU and FSO units into your group, or does it exclude them? That's all. Thank you.
Okay. Now, I'll give you a simple analysis of how the government share works. Government, whatever the revenue generated, government is having a stake. If I generate $1 million per day, then I have to share with the government 55. So in that model, if you look at that, if I generate about say $150,000, say $250,000, I expect it should not be more than 1/4 of the money therein. So it's starting with about $12, it's 12.5, it goes up to 20. I taken the maximum upper limit of 21%, because it will produce some oil thereon too also. So with that, we have considered 25% goes to the government thereon, right? So now your next question goes about operating cost. The operating cost is standalone. That goes from, which is like any third-party contractor, this BIT field has to pay for HOEC subsidiaries. That is about $97,000 a day. They have to pay for it. Okay. Now, whatever the revenue generated out of the D2L sales, first charge goes to these operating expenses. After meeting the operating expenses, after meeting the government revenue, the balance will come. That I estimated in the year and annual to be about 70 crore cash net. Okay.
So the line for the participant dropped. We move to the next question. Next question is from the line of Abhishek Jain from individual investor. Please go ahead. We move to the next participant. The next question is from the line of Natwar Gupta, individual investor. Please go ahead.
Hi, can you hear me?
Yes, please.
Hello.
Yes, go ahead.
I'm going to ask a question relating to Diroc. Now, Mr. Lango mentioned that, the customers are price sensitive, and the price being $6 around. And given how the global gas prices are, I anticipate that, when the next revision comes, they are going to be even higher. So in some ways, you're saying that, the volumes might be constrained because the prices are high and the customer is sensitive to pricing. Now, with that backdrop, you mentioned that, you're doing the pipeline to Dulijan. Once you do that, do the customer mix change, or is it the same customers? Does it, give you access to more customers once you have done that pipeline?
Yeah, yes. Once we do the pipeline, obviously it allows us to access few more customers, but individually they are not may not be large customers. Mostly all the large customers are already connected through the Oil India pipeline. So that's not a coupling drive. But what it does is it kind of helps in meet certain sectors are not really sensitive to the price. For example, any refinery running, your gas is competing with fuel oil, which is substituting the fuel oil. Therefore, if you're accessing the refinery directly, they are not very sensitive to the prices. One. Power sector, the government has pushed them to continue the production, whether they make money or not. So we have also seen power sector drawing. It's difficult to really see in the next price increase how some of these customers' behavior would be. But having said that, we see the pipeline as more of a strategic investment, which allows you to directly reach the market and reduce your dependency on Oil India at one level. And the other level is to kind of de-risk the DROC from the point of view of today. If there is any kind of failure in that Oil India's pipeline, then we will not be able to supply it to anyone. But having our own pipeline gives that sense.
So when do you expect the pipeline to be up and running? And second, in terms of demand change in that area, what I could then figure out is that only when Numilgarh refinery the capacity increases, they're doing a capex there, then sort of the demand supply balance changes. Would that be correct? And if that is so, then when do you expect that expansion plan to conclude?
Yeah. The first thing is, a huge northeast gas grid is being built by the government based on the demand that has been assessed in the entire northeast region with a lot of unserved areas as such. Government is actually given a project. It's a subsidized project by government to create that infrastructure being implemented by GAIL. That work is going on stream. But one interesting part of that network is that has the ability to flow the gas out of Assam also and connect it with the rest of the India. So it's like what you saw when the entire power grid in India got connected with multiple regions. You see the demand being managed much more efficiently across the region. So we do expect that to happen, but that's more like 25, 26, FY25, 26 scenario. But all I know is both the Numaligarh expansion project as well as the Northeast Gas Grid project has been given highest priority by the government. There are no local issues. All the approvals have been given to them on priority, and the execution is going on full swing.
Right. Now, can I move to PY1, where you have done a settlement on royalties? So now, what does that change compared to the earlier numbers of royalty?
Basically, earlier, as per the statute, the royalty has to be paid at 10% of what is designated as wellhead value, which means whatever is the sales price you realize, you deduct the transportation and treatment cost for the gas from the wellhead to the delivery point, which is onshore. In our case, the wellhead is in offshore, the delivery point in onshore. So under the statute, we are allowed to do, because the royalty is always levied on wellhead. Now, after the entry of multiple private sector players, the government, through various audits, found that this is creating a lot of problem for them. So they wanted to fix that sales price is the pricing point. You pay 10% of the sales price, which is not really in accordance with the mining license conditions or rules. So we felt we are very strong statutorily, legally in our calculation, and from a president's point of view, since independence or since commencement of gas production in this country, we know that royalty has always been paid by both Oil India and ONGC at the 10% of the wellhead value only. and both Jiva and me worked in ONGC for more than 10, 12 years. We know exactly how this is done. But the way we reached a settlement is basically the government took a view, look, I'm facing a lot of problems with multiple players. All of you would pay from 10% of sales price as royalty. So in the DRC, we have they made some kind of a settlement proposal, which I am not allowed to disclose as such. But to answer your question, going forward, it doesn't change it any way other than we will pay 10% of the sales price as royalty, and that we have already started doing.
Thank you. I request all the participants restrict to 2 questions per participant. The next question is from the line of Chetan Phalke from Alpha Investco. Please go ahead.
Yeah. Good afternoon, and thank you very much for the opportunity. Sir, this is regarding our exchange release dated 24th of February 2020, in which we had published our test results for D2 well. So at various choke sizes and pressure flows, the production can vary anywhere between 15 to 23 mmSCFD as per the press release or the exchange release. While our sales type with GSPC is only, let's say, 10 mmSCFD, and we have been talking about 10 mmSCFD production and sales. So just wanted to understand, when our minimum production capacity as per the test result was 15 mmSCFD, is there any change in our or any revision in our production plan for this D2 well?
No, we've based on test results or even before the test results, we have indicated the gas capacity, gas production to be 15 million cubic feet, and we always have our own internal consumption. All the systems in the top side is run through gas, so there is an internal consumption, which we estimated anywhere between 2 to 3 million cubic feet. So we were comfortable with 12 million cubic feet as a sales number. And when it comes to commitment, where there is a take or pay as well as supply or pay model is there from after first year onwards, we thought it is prudent to commit 10 million cubic feet. I want to emphasize that we have always have the option to offer the gas at exchanges also. Any excess gas that we produce, we can always sell it to any other customers also. So all the flexibility we have built in, but we just want to proceed on a conservative basis.
Okay. So is it fair to assume that once things stabilize, there is a chance that our tie-up can be higher than 10 mmSCFD?
Yes, very much.
Okay. Any ballpark number how high we can go whenever things normalize? Not asking for immediate guidance, let's say after a year or so.
No. I said we have a limitation in terms of process capacity of 15 million cubic feet. We have the internal requirement of about 2 million cubic feet. So it can vary anywhere between 10 to 12, 13.
Okay. So the process capacity has to be taken up just in case the production capacity goes to more than 50.
See, overall, the gas or oil production is really determined by our reservoir management team, which looks at the long term. How do you maximize your recovery over a longer period as such? What is the maximum you can recover or optimum? So they decide what is the optimum rate of production based on pressure data and other data they see. And we follow that only.
Thank you. The next question is from the line of Rishik Parekh from Barclays. Please go ahead. Rikesh Parekh, may I request you to unmute your line from your side and go to the question, please? Rikesh Parekh, due to no response, we move to the next participant. Next question is from the line of Tejas from Unique Stock Broking. Please go ahead.
Yeah. Hi. If you can share on the expenses on the other interest, what is being charged, and again the vessel cost also being charged on the consolidated. If you can throw some light on that.
See, our cost of capital is less than the debt capital is about less than 9%. And whatever the your next question, that's our we are getting our interest rate is by gross currency swap, it is less than 9% for all our borrowings. So what is the question, other?
There is a cost in other charges. You mentioned interest cost. In that, on the consolidated balance sheet also, there are other vessels also on 2.37 also.
Yeah, right. As I told you in that assets, the vessel, the prime price, whatever the floating storage offshore and the single point mooring system, and on the 26th of December. So it is in an operating mode. All the costs related to the operating expenses, the system is fully commissioned. Its revenue earning is linked to the BAT production. That's why the cost is in the balance sheet, which is the order of around, that is company has suffered a loss of 11 crores for this 3.5 months, including the depreciation, which is in the order of about 7 crores.
Okay. And normally you charge depreciation, depletion, and there are some other also. So will that be charged on full, and what will be the effect after the BAT starts? Means, let us say the BAT starts, then the depreciation, depletion cost will come to what, and whether it is 10% of the turnover. Even on the royalty side, if we see, it's around 20% is the royalty on the top line. What exact right today what we are paying right now?
Okay, I can tell you what is happening is such. On all the, in case of BAT, the royalty is 10%, either case, whether it is an oil or gas. But in case of gas from Duroc, which is our major revenue, royalty is 10% of the gas, but whatever the condensate we produce, we have to pay 20% royalty, and then we have to pay 20% cess after adjusting the royalty. In effect, it comes to around 38% of the revenue earned through oil in other blocks. Okay, so that is a major thing. If you average it out, probably you may be looking at a number of say 20.
Thank you. The next question is from the line of Nirbhay Mahawar from N Square Capital. Please go ahead.
Yeah, I just wanted a follow-up regarding our existing portfolio development.
Nirbhay, sorry to stop you. Your voice is breaking. I request you to come in a better reception area.
Yeah, I just wanted to follow up regarding our existing portfolio development. Are we open
Nirbhay, sorry to interrupt you once again. Can I request you to come back in the question queue, please?
Okay,
thank you. The next question is from the line of Ashwin Reddy from Samatva Investments. Please go ahead.
Yeah, hi, sir. Thank you so much for the follow-up. So first question is on Duroc. So the reduction in volumes in Duroc that we have seen, how much of it is due to the higher APM price post April, and how much is due to the maintenance shutdown in the DCPRL refinery?
The number that you've seen are for the last quarter. In the last quarter, there was no price increase. That is January, March quarter. Lower price. That is mainly due to shutdown and seasonal lower demand by the customers. The new price of $6 plus is effective 1st April. So in April, we saw a bit of a price shock within the customers to minimize it off. But in May, about a week back, we started again seeing picking up of demand. So I think by end of this quarter, we'll get a more clear picture on how much is the impact of price increase. But overall, we find mostly any shutdown in any of the major customer impacts us.
Right,
got it. This quarter we'll get a better sense.
Got it. And second question, sir, or as a clarification, so the 75 to 80 crores number that we mentioned that we would get from operating purely the gas well, is that right? So is this the consolidated number at consolidated cash flow or only at the standalone? Because it also includes whatever you get at consolidated level.
Yeah, Concall level we'll be getting a better number as such, because then I have the two vessel revenue generation would also be there. So we will be expecting some oil production from the D2 well also. With all put together, I'll be touching a number of over 100 crores.
Okay. But this is your share. But this is your share, or this is this unaffiliated is only your share, right? Not to a partner.
Our share.
Got it. Got it. Great, sir. Thank you so much.
Thank you. Next question is from the line of Chitresh Lunawat, an individual investor. Please go ahead.
Hello. Congratulations on the B80 field. I just wanted to know, like, by when we can expect the D1 to be commissioned, like any gross date we have available?
I wish I can give you a specific date on that. I think we explained that we will be making whatever term we just open pray, it ends up successfully.
Sure. And other wells part in the presentation is missing in this particular presentation, like updates on other wells. So that was included in the presentation earlier. So any reason for excluding them? I mean,
you mean the other blocks?
Other blocks.
Yes. No, we will be uploading the investor presentation. In the evening, what we have done is the earnings presentation highlighting the quarter results on each of the block. But we will have a comprehensive update on all other blocks also.
Okay. So, as per earlier talk from the management, like we are expecting to reach around 14,000 equivalent of barrels oil equivalent per day in the next 2 to 3 years. Are we on track for that?
Yeah, I think the current year focus is on getting B80 on full stream and also investing after that, as you emphasized, we will focus on addressing some of the working capital issues, bringing down the debt level, as well as doing the investment in the existing portfolio of Dirok, Fever 1 and Western assets. Our value of our portfolio remains, but investment only will unlock the full value. That will be determined purely by when we are able to get the full production from B80.
Thank you. The next question is from the line of Rushul, individual investor. Please go ahead. Rushul, may I request you to unmute your line from your side and go with the question, please?
Yeah, am I audible?
Yes.
First of all, thank you for the opportunity and congratulations on commencement of the production. My question is, we have some carry forwarded losses. So just wanted to understand if you can throw some light on the amount of losses we have in terms of carry forwarded and the set off duration we have or the time we have to set off in terms of number of years.
Okay. So carry forward loss in as on 31st March will be about 841 crores. The majority of them are the depreciation, which is no time limit under the law. So we should be comfortable as such to reach a number of 841 crores.
Okay, thank you. That was the only question from my end.
Thank you.
Thank you very much. I now hand the conference over to Mr. Amit Sonpal for closing comments.
Thank you everyone for joining us. I would request if management has any closing comments. Over to you, Lango.
Yeah, thanks Anuj, and thank you everyone for participating in large number. Overall, considering the huge investment that HOEC Group has made in B80 and critical tasks that are yet to be accomplished, we wish to remain focused on B80. Post full production from B80, we will take up investment in our existing portfolio to grow the production in this attractive price environment. Thank you again.
Thank you very much. On behalf of Hindustan Oil Exploration Company Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.